All right, so in one of Uneducated Economist's videos, somebody had made a comment about how to apply the information about the neutral rate of interest, the Federal Reserve raising interest, inflation, and kind of the um, the non-typical or the unconventional um, ways that folks like us interpret the economy. It's like, it's all well and good to have, this understanding of the real impact of interest rates or, the Federal Reserve's actual monetary policy strategy, wherein they are comfortable with letting inflation run, extra high for an extended period of time in order to compensate for all those years where inflation ran below their 2% target. And we know that the Federal Reserve conducts monetary policy in a recession by lowering interest rates, right? That's their ammo. That's their line of attack, right? To quash inflation. But we also know that in order for them to have this ammo, they need to have an environment where interest rates are high to begin with, because they can't lower interest rates when the interest rates are low to begin with. And so here we are in 2024, and interest rates are about 5.25 for the Fed funds rate, the effective Fed funds rate. And a commenter was asking, okay, well, this is all well and good to understand, but how might I actually use this understanding to benefit myself? And here's the thing. If you know that the Federal Reserve is not going to be is not going to be lowering interest rates as soon as people think that they are, then you're not going to be one of these people who's placing bets that the Federal Reserve is going to lower interest rates anytime soon. And in fact, you can also be one of the people that takes the opposite side of those bets and be more likely to win, right? And be more likely to profit. And so I've taken the same Minsky model that I built in the previous video where we answered Senator Loomis's question about the order in which monetary policy takes place in relation to fiscal policy. And what I'd like to demonstrate is the effect that raising interest rates has on the economy. Okay, so right now I have that the government is not running any deficit, and that the interest rates on bonds held by the banking sector, or well, in this model I only have that the banking sector buys the bonds, and I'm just going to illustrate the effect that raising interest rates has, in principle, on economic activity. Okay, so right now, the interest rate on bonds is 0%. The Federal Reserve isn't buying any bonds, and the government is not running a deficit. Okay, so taxation and spending are equal to each other. I also have that there's no net lending going on in the economy. Okay, so if I press run, what's going to happen is that this is going to reach a steady state where everything is going to be in equilibrium with these settings. Okay? And then we're going to raise the interest rates and see what happens to economic activity. So I'm going to press run, and we can see that we've already basically hit a steady state. GDP is at about 75 billion. The debt ratios are constant. Bank accounts are constant. Growth rate is constant. Money velocity is constant. Everything is constant. Okay? And so now what I'm going to do is I'm going to raise interest rates to 5.25. Okay? I'm going to raise them, raise them, raise them, raise them, raise them. And here we are at about 5.25. And you can see that the equity of the banks is increasing. Okay? The deposit accounts of the firms are increasing. GDP is increasing. The money supply is increasing. Why is all of this increasing? Well, because of the interest income that the banks are receiving from the bonds that they hold. Okay? And the reason why this is important, and also GDP is increasing, and the debt to GDP ratio is decreasing because we're not issuing any new debt, but GDP is increasing due to the fact that the the banks, the equity of the banks is increasing, and the consumption of the bankers is a function of the bank's equity, and the consumption taking place within the economy is what is responsible for GDP in this model. We have a consumption-based economy, right? So consumption drives GDP. So anybody who gets interest income from holding bonds is going to be consuming with that interest income, and that consumption is going to be raising GDP. All right? So just the interest channel, all right, it can produce an increase of GDP. Again, how do you use this information? Well, people think that raising interest rates is bearish on GDP. They think that it's bearish for the stock market. They think that it's bearish for the housing market. All right? But we can see just from this model that the effect of raising interest rates has on the economy is to increase GDP. It increases consumption in the economy. It increases economic activity in the economy. It increases the equity of the banks. It increases the deposit accounts of the private firms, the producers of goods and services. All right? So you can't be bearish on the economy when you have interest rates rising as much as they have. All right? That's a fool's bet. You want to be long the U.S. economy. All right? And for me, personally, what I do with this information is I hold short-term treasuries. All right? It's a free 5% interest rate of return. It's a free 5% return. And as long as the United States government is taking on more debt and not paying it off, you, the bondholder, are going to be continuing to receive that interest income. All right? So I've already named a couple ways that you can apply this understanding. If we know that inflation is going to be high because the Federal Reserve wants it to be high so that the Federal Reserve can keep interest rates high, so that when a recession inevitably happens for whatever reason, like some sort of shock transpires and they need to stimulate the economy, all right, then you know that until that shock takes place, you want to hold bonds, all right? You want to hold bonds. You want to be long the U.S. economy. Now, I'm sure that some of you are going to be saying, well, when is the recession going to be taking place? The recession is going to be taking place when the government actually starts paying off debt. All right? Because if I continue to run this model and now I have that the government raises taxes, all right, boom. All right? GDP goes down. The money supply goes down. Incomes go down. Bank equity goes down. So if you have a Congress or a budget where the national debt is being paid off, what does that mean? That means that bonds are being are being called to maturity early. Okay? If you are somebody like me and you hold a bond and the government decides to pay off its debt, you're going to lose out on that interest income. That's money out of your pocket. That money out of your pocket is going to be less money that you have to do consumption with. The less consumption that you do, the lower GDP goes. All right? So this is what you want to look out for. You want to look out for the Congress or the Treasury paying off the national debt. You want to look for the deficit reducing. Okay? This is how you apply the information. Okay? What you want to do in our current environment is you want to hold bonds and you want to be watching out like a hawk for any signs that anybody in this government is going to get serious about paying off the national debt. All right. Fortunately, we have a Congress and a government that does not seem too keen on paying down the debt. In fact, the Congressional Budget Office put out a projection that says that we're going to be keeping on running these $2 trillion deficits every year. That is bullish on the U.S. economy. Why is that bullish on the U.S. economy? Because if you have the public sector going into negative equity, taking on debt, necessarily that means that the private sector is going to be getting positive equity. All right? It is just the nature of the double entry accounting that we demonstrated all those days ago when we set up the balance sheets of the Treasury and the private firms. Okay? The private firms, the private banks, all right, the Fed, and the Treasury. You can go back into my previous video where we walk through and we put this model together and we show that just by virtue of the double entry bookkeeping of, just by virtue of double entry bookkeeping, the way that accounting works, all right, somebody's liability necessarily has to be somebody else's asset. The liability of the government sector is the asset of the private sector. Okay? So the public debt, the national debt, is the income stream of the private sector. All right? I'm not holding back here, guys. If you want to be able to apply this information, this is how you do it. You have to understand what is going on. All right? So, again, like I said, the way that I apply the information personally is that I know that interest rates are going to be high, and they may even go higher because the Federal Reserve wants to have firepower to combat a recession. Why would a recession take place? A recession would take place either due to some sort of economic shock or the government reducing the national debt, the government reducing the deficit. Okay? This is what you want to be looking out for. And until such time as that is the case, where that is a likely scenario, you got to be long, you got to be long the U.S. economy. You got to be long equities. You got to be long the stock market. You got to be holding treasuries because that is interest income into your pocket. Hope this helps.